Welcome to the deep dive. You've probably been keeping an eye on the markets lately.
Exactly.
The inflation numbers, all the geopolitical stuff, those, daily swings.
Yeah,
And you're probably thinking, how do I protect my capital? Maybe even, how do I grow it in this kind of environment?
it's a real pressure point for anyone active in the markets, isn't it?
It really is. And navigating these waters, it takes more than just hoping things turn out okay.
Definitely. It needs a, let's say, a pretty robust approach, a considered approach to managing your portfolio.
Exactly. And that's what we want to unpack for you today. We're going deep into this idea of building resilient trading portfolios.
Right.
And specifically, we'll look at how managed account services might be, one way to build that kind of sturdier portfolio.
Our goal here isn't just surface level. We want to really get into what makes a trading portfolio genuinely resilient. Like, what does that mean in practice? Something that can handle these turbulent times. And then look at how these managed account services are, well, supposedly designed to offer that stability and maybe some sustained growth too.
Okay, so to frame this, we're drawing on materials and insights from Fida Ventures Ltd. We're looking specifically at their take on developing trading portfolios that can, stand up to market pressures.
Okay, so let's dive right in. The core question: what is a resilient trading portfolio? It's not just about chasing the biggest returns, is it?
No, not at all. Based on what Fata Ventures puts forward, it has a few key characteristics. First, it's built to sort of absorb those sudden shocks the market likes to throw at us.
Like a shock absorber, yeah.
Exactly, for your capital. Second, when you inevitably get those the drawdowns, it's designed to recover efficiently. It doesn't just, get stuck.
Right, it bounces back.
Huh.
And crucially, it needs to be able to perform okay across different kinds of markets, yeah. Not just when everything's going up.
Precisely. Which implies a good degree of adaptability built right in.
That adaptability sounds key.
It is. That's kind of the fourth point.
Yeah.
It adjusts dynamically without you having to constantly be in there tweaking things. But here's where Fata Ventures adds an important layer, I think.
Okay.
Resilience isn't just offense, chasing gains. It's just as much about defense, preserving capital,
Okay.
controlling your risk exposure very carefully. It's about finding that balance.
That balance feels especially critical right now.
Mm-hmm.
Growth potential, sure,
Yeah.
but protecting what you have.
Mm-hmm.
So it sounds like it's about discipline, consistency, having a framework,
Uh-huh.
not just reacting to the latest headline or fear.
You got it. So with that definition in mind, let's look at how managed account services, again, through the lens of Fata Ventures, are structured to try and deliver that resilience. What are the core advantages they point to?
Where do they start?
Well, the first big one they discuss is automated execution with human oversight. Now, automation can sometimes make people think of like pure robots trading away.
Right, just algorithms running wild.
Yeah, but Fata Ventures really stresses the human oversight part. It's a blend.
Okay, tell me more about that blend.
So they use these things called expert advisors, or EAs. These are algorithmic systems, basically, designed to trade 245.
Based on tested strategies, presumably.
Right, based on strategies they've developed and tested. So you get the efficiency, the speed of automation. But, and this is the crucial bit they highlight, these aren't just fire and forget systems.
Okay, so not completely hands-off.
No, they say professionals are actively monitoring them, they're fine-tuning them, adjusting them based on what's actually happening in the live markets, and also keeping the client's specific goals in mind.
I see. So the automation handles the emotional bias removal, maybe? Stops the panic selling or the FOMO chasing.
That seems to be the idea, yeah. It takes out that emotional roller coaster.
But the human layer adds the adaptability. Adjusting things if the market suddenly changes character in a way the algorithm wasn't expecting.
Exactly, because markets do shift, don't they? So that human judgment is layered on top. Makes sense.
It does, especially in unpredictable times. Okay, so that's the first advantage. What's next?
The second key area they focus on is their built-in risk control frameworks. This really gets to the heart of that capital preservation point we talked about.
Right, the defensive side. So this is the nuts and bolts of how they actually try to protect the capital.
Mm-hmm.
What specific tools are we talking about here?
They mention a few specific things. One is defined maximum drawdown thresholds.
Okay, so like a hard stop loss for the whole account, almost.
Kind of, yeah. It sets a limit on how much the portfolio value can drop before certain actions kick in. It's like a pre-agreed line in the sand for loss management.
Got it. What else?
They also talk about using equity-based trade closures. This is interesting. It's about proactively locking in profits.
How does that work?
Well, for example, if the account equity hits a certain profit target or level, the system might be set up to automatically close out some or all open trades.
Ah, so it's not just waiting for a price target on a specific trade, but looking at the overall account profit and banking it.
Seems that way, yeah. Taking gains when they're there.
Interesting.
Yeah.
Any other risk tools?
They also mention lot sizing logic tied to account balance. Basically, the size of the trades adjusts based on the total capital.
So as the account grows, trade sizes might increase proportionally, and vice versa if it dips. Helps manage overall exposure.
Right. And finally, they also emphasize diversification. Spreading risk across different currency pairs, different instruments, that's another fundamental layer.
Okay, so it sounds very structured, very disciplined. It's risk management embedded in the process, not just an afterthought. And diversification, well, that's always key, isn't it?
Absolutely. Which leads nicely into their third point, diversified strategy allocation.
Ah, so not just diversifying assets, but diversifying the methods used to trade those assets.
Exactly. Their thinking is relying on just one single trading strategy, no matter how good it seems sometimes, leaves you vulnerable. Markets change, strategies go in and out of favor.
Makes sense. You don't want all your performance riding on one horse, so to speak. How do they actually do that? Implement strategy diversification.
They explain they use multiple EAs, those automated systems we mentioned, but each one is designed differently.
Okay.
Some might focus on, say, short-term charts, others on longer-term trends. Some might be built for trending markets, others for range-bound markets, and they might trade different instruments too.
So the idea is to smooth out the ride. If one strategy hits a rough patch because the market isn't suited for it right then.
Hopefully another strategy that likes those conditions can pick up the slack, or at least offset some of the losses. It aims for a less bumpy overall equity curve.
Right, the classic, don't put all your eggs in one basket idea, but applied to the trading logic itself. Do they give examples of these different EAs?
They do mention a few, yeah. There's one called Theta Neural Trader, which they say does well during market breakouts, those big, fast moves.
Okay, momentum-based, perhaps.
Possibly. Then there's Theta Profit Plus, which seems linked to what we discussed earlier, locking in profits using those equity-based exits.
Right, the profit-securing one.
And they mention Theta Alpha Trader, which they describe as spreading risk across multiple currency pairs using some kind of synchronized logic.
So different specialists, essentially. One for breakouts, one for securing gains, one for broad diversification across pairs. It's like a team approach within the portfolio.
That's a good way to put it. A layered approach, complementary strategies, all aiming to reduce that overall volatility and cushion the blows if one system isn't performing well.
Okay, that makes sense. Automation with oversight, built-in risk controls, and strategy diversification. What else do they highlight?
Well, shifting slightly, but they say it's just as vital, transparency and trust.
Ah, the softer side, but arguably essential when you're handing over control of your capital, right?
Absolutely. If you're using a managed account, you need to feel confident and, well, trust the process. Transparency is how they aim to build that.
So how do they provide that transparency? What tools or practices do they use?
They talk about providing clients with live reporting dashboards, so you can log in and see what's happening, your performance, in real time. Okay, direct visibility.
Yeah. Plus verified trade history, a clear record of all the trades, and real-time equity tracking, so you always know the current value.
That level of access is important, definitely. Keeps clients informed, empowers them, even if they're not making the day-to-day decisions. How do they align their interests with the clients?
They mention using profit-sharing models.
Okay, so they only make money if the client makes money.
That's the principle, yes. Their compensation is linked directly to the profits generated for the client. It creates that shared incentive, theoretically.
Right.
The overall message seems to be, you stay informed, you feel in control, but without the stress and the constant need to watch the charts yourself.
Okay, so let's try and tie this all together. We've done this deep dive, looked at resilient portfolios and how managed account services, particularly from Theta Ventures' perspective, fit in. What are the main takeaways?
Okay, key points. Building a resilient portfolio, it's definitely more than just chasing high returns, isn't it?
Yeah, much more. It really seems to depend on strategic risk management, first and foremost.
Absolutely. And diversification, not just assets, but as we discussed, diversifying the strategies too.
Right. And consistent execution, having those defined frameworks and sticking to them.
And these managed account services, as Theta Ventures describes them, offer one potential path. They combine that automated execution.
Right. With the human oversight, yeah.
And they emphasize having those risk controls built right and drawdown limits, maybe proactive profit taking.
Plus the diversification across multiple EAs designed for different market types.
And underpinning it all, that focus on transparency, the reporting, the profit sharing. It's all meant to build trust.
So ultimately, the promise or the value proposition they're presenting is aiming for potentially steady growth.
But with a strong focus on protecting capital first.
And maybe offering some peace of mind, especially when, markets are as choppy as they are now.
Yeah, reducing that day-to-day stress.
So, for you listening, as you think about your own goals, your own approach, it kind of raises a question, doesn't it? How might a more structured, maybe automated approach, but with that professional oversight, fit into your picture? It's definitely worth considering how really focusing on risk management and diversification could make your own portfolio more, resilient.
And if you do want to explore these ideas further, maybe see more from Fata Ventures themselves, they have a YouTube channel. You can find it by searching for @FataVentures.
Okay, one final very important point, though. A necessary disclaimer here.
Yes, crucial.
Everything we've discussed today is purely for educational and informational purposes. Fata Ventures Ltd., they are not a regulated financial entity.
That's critical to understand.
So before making any investment decisions whatsoever, it is absolutely essential that you consult with a properly licensed and qualified financial advisor who understands your specific situation.
Always get professional, personalized advice.
Couldn't agree more. Okay, thank you for joining us for this deep dive.
We'll catch you next time.